It's been looming over our heads for quite a long time. But now is the time that we admit that inflation is here. It isn't just a gloomy term or just a so-called financial term that only affects the stock market. Inflation is closely related with the daily life of everyone. Just watch this video to the end to know how. Hey guys, welcome back to the Ring of Knowledge, your trusted source of practical financial knowledge for a wealthy lifestyle. For a rich lifestyle, you need to get through the tough financial times. You first need to understand the enemy first, before defeating it. So, in today's episode, we're going to learn 10 things to know about inflation. Before moving on, subscribe to the channel and smash that like button. So, without wasting much time, let's get started. Basic definition. First of all, we need to know what inflation is. Inflation is defined as an increase in prices that results in a loss of buying power over time. The average price increase of a basket of selected goods and services over time might show the rate at which buying power declines. The increase in pricing, which is frequently stated as a percentage, signifies that a unit of money buys less than it did previously. Inflation is distinguished from deflation, which happens when prices fall but buying power rises. In simple terms, inflation is the reason why a gallon of milk now costs more than it did last month and much more than it did 50 years ago. It's commonly referred to as the CPI, or Consumer Price Index. How inflation takes place. While specific product price increases are easy to track over time, human needs extend beyond just one or two things. Individuals require a wide range of items and services in order to live a pleasant existence. Commodities such as food grains, metals, and fuel, utilities such as power and transportation, and services such as healthcare, entertainment, and labor are examples. During the pandemic, unprecedented government stimulus helped keep consumer demand high, but supply chain bottlenecks ensure supply can't keep up. Add to that ongoing labor shortages, which are driving up wages, and you have a perfect storm of growing inflation. Inflation seeks to assess the overall impact of price fluctuations on a wide range of goods and services. It enables a single value representation of an economy's growth in the price level of goods and services over time. How inflation affects you. As prices grow, one unit of money buys fewer products and services. This loss of buying power affects the cost of living for the general people, resulting in a slowing of economic growth. Economists generally agree that persistent inflation develops when a country's money supply expansion outpaces economic growth. As the cost of everyday items rises, your salary may not cover as much as it used to. Prices for automobiles, housing, gas, and gadgets have been significantly affected. To fight this, the monetary authority like the federal bank manages the money supply and credit in order to maintain inflation within acceptable levels and the economy functioning smoothly. Moderation is essential in most aspects of life. Inflation is beneficial since it indicates that the economy is growing. However, fast rising costs might significantly reduce consumers' purchasing power or require retirees to dive deeper into their savings than anticipated. Official figures. The yearly inflation rate in the United States is 8.6% as of May 2022. This suggests that purchasing the same basket of products as the average American consumer in May 2022 would cost 8.6% more than purchasing the same things in May 2021. This was the highest rate recorded in over 4 decades. Economists predicted this number to be slightly lower this month, since prices were already high in May 2021, so the growth is coming from a greater base. The Produce Price Index, PPI, which grew 10.8% in May 2022 compared to May 2021, may also be used to examine changes in prices for the basket of commodities that farmers normally purchase. One of the Federal Reserve's, aka the Fed's primary objectives, is to manage long-term inflation near 2%. The 2% objective is intended to make inflation moderate and predictable, reducing its impact. Historical inflation. Monetarism is a common hypothesis that explains the relationship between inflation and an economy's money supply. Following the Spanish conquest of the Aztec and Inca empires, for example, vast sums of money and silver flowed into the Spanish and other European economies. The value of money declined as the money supply expanded fast, contributing to swiftly rising prices. In recent history, inflation usually occurs after a conflict when the economy recovers to a more normal pace. Rising oil costs are another prominent cause of U.S. inflation. The 1970s was the most well-known period of long-term inflation, which was driven by two concerns with oil supplies. Oil prices also fueled inflation in the late 1980s and early 1990s during the First Gulf War, but it hasn't been a major worry in the United States since then. then, reasons of inflation. Till now, you would have understood that inflation is caused by a rise in the quantity of money, which can occur through several causes in the economy. Monetary authorities can boost a country's money supply by 1. Printing and distributing additional money to citizens, 2. Devaluing, aka lowering the value of the legal tender currency, 3. Creating fresh money as reserve account credits through the banking system by acquiring government bonds on the secondary market from banks, and practically this is the most common method. In all of these circumstances, the money loses buying power. There are 3 sorts of processes that generate inflation: demand pull inflation, cost push inflation, and built-in inflation. 1. Demand pull inflation occurs when there are insufficient items or services being produced to meet demand, leading prices to rise. 2. In contrast, cost push inflation happens when the cost of producing goods and services rises, causing firms to raise their prices. 3. Built-in inflation, also known as wage price spiral, arises when employees seek greater compensation to keep up with growing living costs. This in turn drives firms to boost their prices to cover growing wage expenses, creating a self-perpetuating cycle of wage and price rises. Current reasons of inflation. Milton Friedman, a financial economist, famously stated, "Inflation is always and everywhere a monetary phenomena. In the long term, if there are more dollars to buy the same amount of things, the prices of those items will rise to divide scarce resources to those who value them the most." However, there are various possible causes for our present pricing increases. Following the onset of COVID-19 lockdowns, demand soon returned and has remained strong. This demand has been boosted further by fiscal measures that have pumped trillions of dollars into the U.S. economy, keeping consumers afloat but prices high. Finally, there's Russia's conflict in Ukraine, which has resulted in sanctions and interruptions in oil and grain production and delivery. Each of these variables may contribute to higher pricing for U.S. customers. How bad can inflation get? Because all international currencies are fiat money, the money supply might expand quickly for political reasons, resulting in fast price hikes. The most notable example is the early 1920s hyperinflation in the German Weimar Republic. The victorious nations of World War I requested reparations from Germany, which could not be paid in German paper money because of government borrowing. Germany sought to produce paper notes, purchase foreign money, and utilized the proceeds to settle their obligations. This approach resulted in the fast depreciation of the German mark, as well as the accompanying hyperinflation. German consumers reacted to the cycle by spending their money as quickly as possible, knowing that it would be worth less and less the longer they waited. As money poured into the economy, its value plunged to the point where individuals would cover their walls with essentially worthless dollars. Similar incidences happened in Peru in 1990 and in Zimbabwe from 2007 to 2008. Zimbabwe hasn't recovered from this till date. What Jerome Powell and Fed did to tackle inflation. Prices could begin to stabilize if supply chain difficulties are resolved, but this hasn't been the case. As the inflation persists, the Fed intervenes and boosts interest rates to slow economic growth and help combat inflation. Chairman Jerome Powell confirmed at a press conference what many economists have been saying for months. The Fed's objective of making a soft landing, slowing growth enough to contain inflation but not enough to create a recession, seemed more implausible. To curb the worst run of inflation in 4 decades, the Fed gradually boosts borrowing prices. Before the Fed would contemplate slowing its rate rises, he added, officials would need to witness prolonged weak growth, a moderate increase in unemployment, and a clear indication that inflation is returning to its 2% objective. The Fed's quick rate rises mimic those of other major central banks, adding to fears about a possible worldwide recession. The European Central Bank increased its key interest rate by 0.75 of a percentage point. The Bank of England, the Reserve Bank of Australia, and the Bank of Canada have all lately raised interest rates significantly. The Fed aims to maintain inflation at a Goldilocks-like level that is neither too high nor too low. If prices fall fast, this is known as deflation, and it might indicate a failing economy. Companies may be forced to slash output and employees if there is insufficient demand. What happens to your portfolio? If you're concerned about your investments, then you need to act on it. Certain asset types are more susceptible to inflation than others. Historically, several asset classes have prospered during periods of growing inflation. Commodities may be especially well suited since they may pass on price rises to customers. Stocks have also performed strongly, particularly U.S. small cap, U.S. value, and overseas equities. There are special financial tools available to protect assets from inflation. Treasury inflation-protected securities, TIPS, are a low-risk treasury instrument that is inflation indexed, with the principal amount invested increasing by the rate of inflation. TIPS mutual funds and TIPS-based exchange-traded funds are additional options. ETF. A brokerage account is usually required to have access to stocks, ETFs, and other products that can help you escape the dangers of inflation. Choosing a stockbroker could be a difficult task due to the diversity available. Gold is also thought to be a hedge against inflation. However, this does not always appear to be the case. That's it for the video, guys. Hope this video provided great info. Press that like button if it did. Comment down how inflation has impacted your life. Share the content to spread the good info. Subscribe to Ring of Knowledge for more amazing and helpful finance content that will put you ahead of the world. Peace out.